Hello, my name is Sydney Zilke. I lost my voice, and which is why I sound like this. But I am going to do this video on the second assignment for week 6 in the financial decision making class. So this week's second assignment is on the accounting versus cash break-even analysis. So first I want to talk about the accounting break-even analysis. So I have my laptop open, I have some notes on there that I will be referencing in order to provide the best information. So the accounting break-even analysis involves determining the level of sales necessary to cover total fixed costs, but that's including cash fixed costs and operating fixed costs, which is depreciation. So that is the major thing with accounting break-even analysis that is different from cash break-even analysis, is that accounting takes into consideration depreciation and fixed operating cost, which is depreciation. So in the accounting break-even analysis, we use the accounting term because the accounting break-even analysis accounts for the depreciation costs or the accounting costs, which are the non-cash flows. So how this is determined is net operating income will equal the total revenues minus the total cost, which will ultimately equal 0. The main benefit of this is that it will take into account non-cash flows like depreciation, and it allows you to get a more full and complete view of how much money is actually going into your operating costs, or into your business, not your operating costs, because that's just a part of it, but it gets you a more complete view of how much money is actually going in to running the business in that time period. Because your cash flows are only cash flows. It's not accounting for the amount of money that you are losing each year that you have your equipment, because it's worth less in the long run. So the cash break-even point is based on the third principle in finances, which is cash flows are the source of value. It tells us the level of sales that we need in order to cover our cash fixed costs, so it doesn't include depreciation, and therefore your total cash flow will be 0 in the end. In a cash flow break-even analysis, we only consider fixed costs that entail a cash payment by the firm, so we don't include the depreciation expenses. Some limitations of these are in a cash flow analysis, break-even analysis, it assumes that sales prices are constant at all levels of input or of output, and break-even charts may be time-consuming to prepare. So if you're gonna take all this time to prepare one, they might not even be that beneficial in the long run with the amount of time that you're spending on them, and it only applies to a single product or a single mix of products. So when you're doing a break-even analysis, it's not for all the products that you sell. So if you run a company, say like Walmart, running a break-even analysis would be very difficult for Walmart because they sell so many different products that it would be difficult. They can't really it would be difficult for them to calculate how many different products. They wouldn't have one product that they're selling in order for their whole business to run, like say a coffee shop. They sell just coffee. Then you can run break-even analysis, but for a company like Walmart, it's way more difficult for them to run that analysis. So those are the limitations of accounting break-even analysis and cash flow break-even analysis. So a real-life example, a business example to illustrate these concepts in financial decision making would be not Walmart. Let's look at an airline. They could use break-even analysis. Actually, let's look at a t-shirt company, a company that only sells t-shirts. let's say they sell a large t-shirt, and that's all that they sell is this one product. They would be able to understand how many shirts they need to buy in order to sell that many shirts in order to make a profit. So what break-even analysis is going to tell them is what their fixed costs are, and how much they can sell this product for, or they'll already know their fixed costs. So it will tell them how much they can sell this product for in order to break even and not incur a loss for this period. For the period of time in which they're selling this t-shirt. So they would then be able to tell how many they need to sell in that time in order to make a profit as well, because it would need to be over that amount. So that's accounting and cash break-even analysis. I used the textbook, so Titeman, Cohen, Martin, in the Financial Management Principles and Applications, and I also used the IB Business and Management site as well. Thank you.